Between January and April 2026, $500 million of personal wealth vanished into thin air. It evaporated in a matter of months, without a single major asset being sold off by its owner. That wealth belonged to South African media billionaire Koos Bekker. He started the year with a net worth of roughly $4 billion. By April 30th, a sustained market slide erased his entire year-opening gain, dragging his fortune down to $3.5 billion. That contraction had immediate consequences on the South African billionaire rankings. Patrice Motsepe, whose mining and investment portfolio held steady through the market volatility, quickly closed the gap, regaining significant ground on Bekker. A drop of this magnitude usually implies a corporate scandal, a bankruptcy filing, or a severe executive misstep, but none of those occurred. The underlying operating businesses Bekker is invested in remain healthy. They are fully functional and generating revenue exactly as intended. This unprompted financial damage reveals a structural trap built into modern public stock markets, and right now, the ultra-rich are actively trying to escape it. To understand the trap, we have to look at the corporate entities at the center of Bekker's portfolio, the South African tech empire Naspers and its European counterpart Prosus. This diagram shows how Bekker's wealth is structured. He holds tiny fractional stakes, 0.93. Because Bekker's fortune is anchored in these holding companies, his net worth acts as a leveraged proxy for that single foreign asset. The 24 parking of fortune in physical hotels offers a mathematical advantage. It creates a deliberate decoupling from the movements of public markets. Bekker's move highlights a macro trend sweeping through dynastic wealth managers. This rotation out of stocks and into private holdings is now the dominant playbook for ultra-high net worth family offices. Family offices are reacting to a recurring vulnerability, the tendency for listed assets to fluctuate based on external market sentiment. As seen with Bekker, a regulatory panic in the Chinese tech sector can automatically devalue a media fortune half a world away, even when the local business is performing perfectly. On the left are replicable listed assets, public stocks. Their pricing is transparent, interconnected, and reactive. For the ultra-wealthy, that transparency is viewed as a liability. Consequently, dynastic wealth is rotating right into private positions, assets the public market cannot value, track, or short. The pace of this migration is accelerating. Analysts are currently tracking these same systematic asset rotation patterns deep inside the massive portfolio of the Rupert family. In 2026, the focus for billionaire capital has moved toward total privatization. The new gold standard is wealth anchored in assets that the global market cannot touch, track, or erase.